very glad that Deshal could join us to make this presentation today. I don't think I need to give any extensive introduction to who Deshal is. He's an economist who currently is a research director at Verite Research, and he has experience across government, private sector, and academia, serving as an economist. So I wouldn't take much of your time. Deshal would give over the presentation to you to take on.
Thank you, Rangula, and very nice to speak to all of you this evening. So I'm going to share my thoughts on the economic outlook, particularly in the context of the significant disruptions that we are seeing as a result of COVID. So I'm going to talk to you through ideas about the implications with regard to the real economy, the external sector, interest rates, and then spend some time speaking about the ramifications from a public finance perspective, and what this means for our external debt obligations, and particularly the large repayments that we have this year and going forward. So, I mean, given the fact that this is very much an evolving scenario, the information is changing pretty much all the time. It's very difficult to have very precise and pinpoint forecasts in terms of things like, okay, what's going to be the GDP at the end of the year, what's the rupee dollar rate going to be at the end of the year. I think it's pretty much impossible to get a sense of that kind of precision at this stage. So what I want to do is really just take you through really just a thought process in terms of how to think about how things are evolving, thinking through a few different scenarios, and what are the big things to look out for from a risk perspective. And in the end, we'll touch on a little bit on opportunities as well. So to start with, let's initially go through the implications for the real economy. Now, the most important thing I think to think about in the very immediate context is the implications that that COVID and the measures that are being taken to address it, the implications on people's livelihoods. Now, basically the Western province has been shut down. The economy has effectively been shut down for the last 2 weeks, and we're not really sure how much longer this would go on for. It's difficult to take judgment from what has happened in China and in some other countries, because systems are very different across different countries, and there are very different circumstances. So from a Sri Lankan perspective, what we do know is that, like other developing countries, we have a very large informal sector. So if we look at the data from the labor force survey of 2018, we can see that one of the most vulnerable sectors is going to be the informal sector in the non-agricultural sector, because the agricultural sector has to a great extent been loved to work. There is still demand for vegetables and fruits and other agri-products, and that part of the economy is happening in a subdued manner, but it's still occurring in some way. But informal employment in the non-agricultural sector, I would say, is very vulnerable at this stage to disruptions to incomes, disruptions to livelihoods. So if you look at the numbers there, it's about 2.9 million people in the informal non-agricultural sector, which is a very large proportion relatively when you consider that our labor force is around just over 8 million people right now. So that 2.9 million, I would say, is a vulnerable sector in terms of their sources of income and basically ability to put food on the table if the lockdown goes longer than a couple of weeks. And then we also have daily wage earners. The number is estimated at 1.9 million. This calculation was done by one of my colleagues at Verite Research, and this basically covers people who, in order to get income, they have to turn up to work. So if you don't turn up to work, you're not going to get any income. So that number is about 1.9, and there can be obviously some overlap between the 1.9 and the 2.9. So the total is not going to be obviously an addition of the two. But a large proportion of the 1.9 million daily wage earners will also be within the 2.9 million non-agricultural informal sector workers. So what we can see is that there's this significant, very material number of people whose livelihoods and sources of income are going to be very significantly affected by the lockdown that we have. And this is something that we're seeing in many other developing countries as well, which is why we cannot consider our situation in the same way that we would look at, say, European countries, the US, and so on, where there the formal economy is much more developed. There are social safety nets that enable transfer of income and cash transfers to vulnerable sectors of the economy in a more substantive manner. So this, I would say, is pretty much a critical headline number to be concerned about, really, from a human perspective, in terms of the impact of COVID right now. Looking at the sectors that are that are likely to be most affected by the developments that we're seeing, I'm dividing this into short-term and medium-term. Where short-term, I refer to sectors which the impact would really be whilst the virus is pervasive in Sri Lanka. So while we have a situation of daily cases increasing, while we still have lockdown or semi-lockdown, these sectors will be adversely affected during that time. The sectors I've classified as medium term are the sectors where the negative impacts will continue beyond the virus being prevalent in Sri Lanka. So even once we have cases in Sri Lanka dropping, once we have lockdowns being eased off, people coming back into work, these sectors will still be adversely affected for a few different reasons. So if you take them one by one, if you look at textiles and apparel, given the fact that they're largely export-oriented sectors, as long as you're going to see demand being subdued in Europe and in the US, which is likely given the significant economic impacts that you're seeing in those regions, our apparel sector is going to be adversely affected during that period as well. With regard to construction and the related mining sector, which accounts for about 10% of economic value added in Sri Lanka right now, that sector, even after we return to some degree of normalcy in economic activity in Sri Lanka, given the fact that this sector is very dependent on government financing, on government being able to put money into capital expenditure, infrastructure projects. And I will talk about later on how the government's fiscal space is going to be significantly eroded in the coming months. So this sector, given that reliance on the government's ability to spend, is also a sector that I think expect to have medium-term ramifications beyond the immediate impacts of COVID. Accommodation and food and beverage, that segment of GDP largely refers to the sector that is the tourism-related area. And here again, for obvious reasons, even beyond the virus being prevalent in Sri Lanka, as long as the global economy is going to see negative effects, you're going to see the tourism sector suffering as well. Now, most of the other sectors, I would expect that once we see economic activity starting to return to normal in Sri Lanka, once the virus, hopefully sooner rather than later, gets under control, these sectors should be able to recover in a more rapid manner. I mean, rapid is probably the wrong word. I think but that recovery will be largely dependent on domestic factors rather than global factors. So that's really what I'd want to limit my comments on the sectoral outlook just to that, because it's very difficult to give a number and to say that, look, I expect agriculture to have X percentage shaved off of its GDP this year and so on, because I think right now, until we get a sense of how long this is going to last, it's very difficult to make a call on that kind of numerical breakdown. So this is just a way of thinking about the sectoral impact of this on the economy. So going on to the external sector. Now here again, we have a number of different competing implications that we are seeing right now. So whilst obviously our tourism, industrial exports, which are major sources of foreign earnings, of forex income, these are obviously going to be adversely affected, during the lockdown period and the curfew period in Sri Lanka, but also beyond that, whilst the global economy is still adversely affected. We're going to see a demand side shock and a supply side shock affecting most of our export sectors. So that definitely will see some negative implications. But at the same time, we're going to see oil prices have come down by about 50% in global markets. So that's obviously going to be an important positive impact on Sri Lanka's balance of payments. But typically, when oil prices come down, we also see negative implications for our remittances after a little bit of lag. Because still a lot of our remittances are from the Middle East, even though those trends are now shifting away from the Middle East to some extent. So that again, we have a competing impact. And also another thing with regard to industrial exports, when exports come down, also you see the intermediate imports that go into those exports coming down as well. So for example, if apparel sector is slowing down, then the imported textiles that go into apparel manufacturing will also reduce. So with a decline in exports, you'll also see a decline in imports. Now, the way that we look at this is, if you see, for instance, if we assume a 50% decline in earnings from tourism and industrial exports, and a 50% decline in oil prices, you're likely to see something like a $720 million net negative impact on the balance of payments. And I've circled that because I think that is, from given the information that we have right now, that is the kind of scenario I think we're most likely to fall towards. And then we can basically look at different scenarios as things go along and see how the overall impact would be. If we have something like a $720 million net negative on BOP, that's really not the end of the world. That's about less than 1% from just less than 1% of GDP. And I think if anything, it will be probably less than that, because we are likely to see a bigger negative impact on imports in the short term, given the measures that are being taken by the central bank as well to restrict imports to support the balance of payments in the short term. So overall, I think the message here is that, look, from a current account of the balance of payments perspective, when we're looking at implications for currency and so on, the current account, it doesn't look like it's going to be a major source of negative shock when you look at things in a balance, given the information that we have right now. What about the capital account? So if you look at the capital account, the biggest source of capital outflows that we have seen in Sri Lanka in recent years has really been from foreign holdings of government securities. So this is foreign investors who have invested in rupee-denominated treasury bills and treasury bonds. When they take their money, when they divest those investments and take the money out, they convert it into dollars, and that basically leaves the economy as an external outflow. So this has been something that has we have seen a sharp decline in foreign holdings of government securities, and this has been going on for a while. So if you take exactly a year ago, first week of April 2019, we were at about just over $165 billion worth of foreign holdings. That has now come down to about $40 billion. So here, I think the message is that, look, a lot of the investments have already gone. So in terms of looking forward and seeing the potential downside impact that this would have on the currency, for instance, is relatively limited. 40 billion rupees is about $200 million. So from an overall balance of payments perspective, it's not going to be a major driver of rupee value going towards the rest of the year. And yet we have seen fairly sharp depreciation of the Sri Lankan rupee in the last couple of weeks. And obviously part of that is, I think, to do with the fact that we had fairly sharp foreign sales of government securities in the last couple of in the middle of March. But still, I think what we have, so for instance, if you take last week, there was almost no sales of government securities by foreigners, but the rupee had one of its worst weeks last week. So I think what is to a great extent driving rupee weakness right now is sentiment. I think investors, traders are worried about the outlook, worried about the overall global situation and some of the policy responses as well. And so that is something, I think it's, then when in that kind of situation, messaging becomes very important, policy signals become very important as well. So let's try to understand some of these policy the policy signals that may have had this kind of implication for the rupee as well. Now, if you look at this year, the central bank has been on a fairly aggressive monetary loosening cycle. So they've been reducing interest rates from January. There was a rate cut in the January Monetary Board meeting, and since then there have been a number of other rate cuts. There have also been a reduction of the statutory reserve ratio, all of which are really looking to push more liquidity into the system. to enable companies and firms to borrow at lower rates, and to make sure that there is sufficient liquidity in markets to enable companies to keep functioning during this difficult time. But of course, what happens is, from a financial market perspective, when interest rates starts coming down, it does drive out these foreign investments in government securities, and it also creates a somewhat negative sentiment from external financial markets perspective. So in this screen, what you can see are market interest rates. On the left, you have the yield on the 1-year Treasury bill, and on the right, you have market deposit and lending rates. So what you can see on the left screen, on the graph on the left, is that even though the central bank since January has been aggressively bringing down interest rates, policy interest rates, the market trend has been pushing against that. So every time central bank try to reduce rates, the underlying pressure in the market has been for rates to continue to push against that, and to either be stable or to rise gradually on a secular basis. That started changing on March 23rd, after which, when the government instructed some of the captive funds, including EPF, ETF, Bank of Ceylon, People's Bank, etc., to invest directly in the treasury market at rates of around 7.5%. So that artificially brought interest rates down quite sharply after that. And on the right side of the screen, you can see the trend of deposit rates, which you can see since the second half of last year have been trending upwards. So deposit rates are really the cost of funds for banks. So when you see deposit trends trending up, you know that the market pressure is for a gradual increase in rates. That typically goes into lending rates after a lag. But so before the implications of COVID, the market was generally expecting interest rates to start rising in the second half of the year. But policy actions are now going to shift that quite significantly. You're going to see rates remaining at a lower level now for the most part of the year, and also the fact that private sector demand for credit is also likely going to be low. So again, second half of last year, we started to see a recovery in demand for private sector private sector demand for credit started to recover in the second half of last year, largely because economic activity started to slowly pick up again. And here again, the expectation pre-COVID was that, look, second half of the year, we'll start to see private sector demand taking off in a bigger way, and that was expected to drive up market interest rates as well. So that's the entire narrative obviously changes completely now. Given the situation that we're seeing, it's very unlikely that companies will be willing and able to look at expansion, investing in capex and so on. So here again, private sector demand for credit is likely to be muted for a lot of the rest of this year as well. So from an interest rate perspective, that's again something to keep an eye out on. But the balance to that is the fact that we are likely now to see government sector demand for credit to start increasing. That's because we're going to likely to see budget deficits increasing, and that will have to be funded to a great extent by domestic markets when global markets are in the turmoil that we're seeing right now. So interest rates is a tough one to call. You're going to see two very competing factors affecting it. From a private sector side and policy side, there'll be pressure for interest rates to come down. But from a government sector side, the government demand side, you're likely to see pressure on interest rates to go up. So that balance is something that we'll have to watch the way it evolves in the coming months. So taking a deeper look at public finances and to try to understand why budget deficits are likely to increase, we need to look back to the history a little bit as well. So Sri Lanka has had very weak government revenue for a long time. So the data on this graph is from 2018, and it shows the government revenue as a percentage of GDP across all countries. And you can see that Sri Lanka's percentage is 13.4%, which is less than half the global median, which in 2018 was 28.6%. Now, 13.4% was prior to the tax cuts that were announced in December last year. and also prior to, of course, the significant negative impacts that we have on revenue as a result of COVID and the disruptions to the economy that will result from this as well. So government revenue has been a critically weak factor by global standards in Sri Lanka, and that has also forced our expenditure to be below global averages as well. So in terms of government expenditure, Sri Lanka as percentage of GDP, Sri Lanka lies at about 18.6% in 2018, whereas the global median was 30.7%. So as a result of the weaknesses in revenue, we've not been able to spend as much as we should be spending in areas like health. Health expenditure as a percentage of GDP in Sri Lanka is just under 2%, whereas upper middle countries average more than 3%. And global averages are even higher than that because advanced economies spend a lot more on healthcare overall. And so these are areas where ideally Sri Lanka should be spending more money in health, education, other public service delivery. But given our weak revenue structures, we've not been able to spend what we should be spending, given compared to our income peers and in some cases our regional peers as well. So we are starting off from a relatively weak position in terms of the budget. So in 2020, the government was pre-COVID expecting a budget deficit of 7.5%. The global median budget deficit in 2018 was 2%. So we are starting off from a point that is a lot worse off on the scale compared to most countries. So when we are facing a crisis of this nature, we need to have the fiscal space to be able to spend more on areas like health, to spend more on welfare and livelihood support on people. But our starting point is one of relative weakness. That gets even more problematic when we look at the structure of our revenues in a bit more detail. So this is again from 2018 when we last had the full year's data. This shows us that 47% of government revenue is collected at the border. Right? So these are import-based taxes, things like customs duty, ports and aviation levy, SCL, cess, the import components of VAT, NBT, and so on. So for almost half of our revenue is collected at the border. Now, what the impact of what we are seeing right now with the reduction of on imports through policy measures and also through general demand trends is that it's going to again have further erode the government's revenue position. And also the fact that the changes that we saw to taxes in December 2019, those changes are really also they were also really reducing our domestic revenue generation capacity. So a reduction to VAT, a reduction to import taxes, abolishing NBT, all of those significantly erode domestic revenue generating capacity. So in actual fact, the reliance on import-based duties would have become even higher as of now. So the disruption that we're seeing to imports is going to have, while it is a positive from a balance of payments and a currency perspective, it's very much a negative from a government revenue and a public finance perspective. So that initial starting position that we saw at, where we were 13.4%, when we take into account the policy tax cut changes that we saw late last year and the implications of COVID on imports and also in general economic activity, this is going to go even lower than where we are right now. So what does this mean for public finance, for a budget and public finances? So what we have on screen here is the expected spending and borrowing and expected revenue from the vote and account that the government is running on now. So the vote and account was passed in October 2019. It runs from January 1st, 2020 until April 30th, 2020. So in blue, we have the voted expenditure, in orange, the borrowing limit, and in gray is revenue expected, which is, it's not stated in the voted account itself, but it is, it's the residual figure, which it's in the pre-election budgetary report, the government says is 745 billion rupees. So on the left side, we have the pre-COVID expectation. And on the right, what I've done is I've looked at a potential 40% decline in the revenue expected. given the impact of COVID and the implications of the tax cuts. Now, what we're going to see is that, look, it's going to be very difficult to reduce expenditure, government expenditure in the current context. In fact, expenditure probably ought to increase, given the necessity for spending on health, necessity for spending on livelihood support, and so on. With revenues coming down, expenditure not being able to come down by much or coming down very little, clearly the borrowing requirement for the government will have to increase. That's what we go back to when I was speaking about the implications of government borrowings on interest rates and credit demand and so on as well. So given these developments, the pre-COVID budget deficit expected by the government for 7.5%, I think it's likely to go into double digits in 2020, given the situation that we have right now. So that really puts us on a very weak wicket in terms of public finances overall, for a country where our public debt to GDP is already over 85%. Running a 10% budget, 10% or more budget deficit is really it's going to be viewed in a fairly pessimistic manner by global markets, investors, and so on. So this is certainly something that we need to keep at the back of our minds. So what I mentioned was that, look, given the fact that revenues have come down, expenses likely to remain constant, the government will have to borrow more in order to fund the necessary spending that we require to respond to this crisis. But there's a constitutional challenge. So Article 148 of the Constitution states that Parliament must have full control over public finances. And the vote on account was approved, as I said, in October 2019. It defines limits for expenditure, and it defines limits for borrowing as authorized by Article 150, subsection 2. But as with revenues coming down, the government will have to increase borrowing, but the government has no authority to increase borrowing without getting parliamentary approval for that. So Article 150, subsection 3 of the Constitution allows the president to draw on the consolidated fund, but there again there is no allowance for increasing the borrowing limit. So the only way to raise the borrowing limit in a legitimate manner is to recall Parliament. And any spending or borrowing that is done beyond this limit is in a legally doubtful position. And this is going to be particularly problematic with regard to external debt repayments, where our foreign creditors are going to would certainly be concerned about the legality of any spending or any borrowing that is done to honor obligations to them. So this is something that it's been in the news in recent days and weeks. We've had a couple of former parliamentarians raising this issue as well. And this is something I think certainly that it's something that the government will have to consider seriously, given the requirements that we have with regard to the types of new expenditure that we'll have to bring in. So in the absence so far of any approved increases in parliamentary approved increases in expenditure and borrowing, what has been happening is the central bank has been buying government securities, which is effectively printing of money. So between the 12th of March and last week, around 170 billion rupees have been injected into the system through printing. That's a little bit more than 1% of GDP, so it's certainly a significant amount. Now, in the current context, there's really very few options that the government has. So it's critical that we fund the essential expenditure that is required right now. And this is really I really sympathize with the fact that, look, there is very few other options that they have right now to manage these cash flow requirements. And in a situation where you either need to fund to support livelihoods, to support lives, there's really no other choices than to do this. And when you think about money printing, people normally are concerned about inflation, but I don't see that as a major short-term concern, because the fact that overall aggregate demand in the economy is anyway quite low and it's quite subdued. So I don't see too much demand pressure being generated by this. But I think it would have contributed to some of the weak sentiment on the currency and investors thinking about how this is going to impact depreciation pressure going forward. So this is something that it's not an ideal. It's not ideal from a policy perspective, but there's very few choices that the government has right now. And there are, of course, ramifications on financial markets when you have money printing of this nature. So let's talk a little bit now about the implications of all this for external debt. So Sri Lanka, we all know that Sri Lanka has a significant external debt problem. We've had large amounts of more than 50%, 54% of our total government debt is denominated in foreign currency. So we have significant external debt repayments coming up every year going forward. From a position again of relative weakness, we've gone into an additional shock, which has affected our sources of foreign exchange earnings. So declines in tourism and manufacturing exports will certainly not help the situation. And also the further weakening of the fiscal situation is again going to make our external debt repayments a lot more challenging. And also equally important is the fact that the current global market risk appetite is very low. In general, investors are moving away from assets that are perceived as risky. So they're moving away from global equity, they're moving away from emerging market and frontier market debt, going into government bonds in advanced economies and going into cash, gold, and other safe havens. So it's not a great time for emerging markets and frontier markets like ours to try to raise capital to refinance our external debt obligations. Now, in 2020, Sri Lanka has external liabilities maturing of approximately $6 billion this year, of which at least $4.5 billion is sovereign debt, and the rest is private debt. And reserves as of February this year was $7.9 billion US dollars. So we can see that purely from a debt repayment perspective, our space on reserves is very limited. We also have, remember, in addition to debt repayments, we also have to fund our general imports. And typically you would want to have reserves covering imports of at least 3 to 4 months. And if you take out these debt repayments from reserves, it's going to be a very thin margin that we have to work with. Now, this problem has been evolving and coming to a head over time. On the left, we can see all of Sri Lanka's sovereign bond ISB maturities. I think we first went to market in 2007, and until 2019, we only had actually two maturities. But from 2019 and going on every single year after that, we have maturing bonds of at least $1 billion in every single year. So the equation is very different now to what it has been in the past with regard to Sri Lanka's debt repayments and the pressures that we are facing. So in the right, what we can see is between 2010 and 2014, our annual average repayments was less than $2 billion. 2019, it was 5.9 billion. This year, it's around 4.5. It picks up again from 2022, above 4.5% in most years going forward. So what we can see is that, look, given our typical reserve position, we always have to keep going back to global markets to refinance our debt. We don't have the reserve space and the external earning capacity to be able to fund these repayment obligations each year using our own resources. So we have to keep rolling it over. So we are very reliant on global markets and whether global markets are willing to lend to us. So the unfortunate thing is that in this current context, the global market is very unfavorable for emerging markets and frontier markets like Sri Lanka. And we can see that in the yields on our government bonds, on our dollar-denominated government bonds. On the right, we can see our ISP yields that have really shot up since early March when the crisis started to really take a head and have significant global ramifications. So you can see these are mainly our 10-year and 5-year bonds, and all of them have gone up into well above double-digit levels. On the left, you have the yields on pretty much all of our sovereign bond issues. The scariest number for me is the secondary market yield on the 4th October 2020 bond, which is at 91.9%. These are dollar yields. So this is pretty much unprecedented for Sri Lanka. So it's what it really says is that, look, even though these may be on thin liquidity and not significant trades happening at these rates, what it tells us is, look, that it's going to be very difficult for Sri Lanka to be able to go to market and raise the money that we need to refinance our debt, given the current environment that we are facing. And that is reflected in our risk premium as well. So on the left, you can see the US Treasury yields, which have actually come down. So US borrowing rates have come down to a great extent, but unfortunately, the risky assets like Sri Lankan debt, the premium has gone up, and our overall yields are now a lot higher. And that refinancing risk was, we saw that materially on 30th of March, when the central bank had auction for $220 million worth of Sri Lankan development bonds. The auction was undersubscribed. There was only 11.9 million out of 220 that was accepted. And this is dollar refinancing from Sri Lankan banks and Sri Lankan banks FCB holdings of dollars. So it's I think indicative of the kind of difficulties that we're likely to face going into market in the current global environment as well. Okay, so policy options. I'm trying to finish this in the next 5 minutes or so. So if we go back to the beginning, what we spoke about was the fact that we have a large informal economy and 2.9 million people, within which another 1.9 million people who will have very vulnerable livelihoods in the next few weeks if lockdowns continue. And the government will have to, and it's in that, given the fact that we have very limited fiscal space, unlike in advanced economies, we may not have the capacity to be able to give fiscal direct cash transfers to this number of people who will have significant income shortfalls. So I think the government will have to relook at some different options from a complete lockdown. We'll have to look at options like maybe sheltering the most vulnerable communities, the older communities, immune compromised people, providing sheltering those communities and gradually opening up the rest of the economy in a limited manner, maybe starting by districts and then gradually opening it up so that people can start getting back to work and starting to earn a livelihood. Because in developing countries, that balance is going to be critical that we strike that reasonably soon. With regard to businesses and small businesses, the measures taken so far by the central bank, I think, have been very timely. They've provided liquidity. The loan moratoriums are important in enabling companies to survive through this most critical, difficult stage. Really, the idea now is not a question of providing stimulus, but providing the liquidity and the support just to keep companies afloat, to make sure that they are in a position to not shut down, to not be shedding workers, so that once we come out of this, the worst of this period, that they'll be able to get back to work and stay afloat and then grow from there. So certainly, what has been done in terms of moratoriums and liquidity has certainly been very positive. Ideally, the government should be also providing partial capital guarantees and funding interest subsidies as well. Because right now a lot of the credit risk is being passed on entirely to banks, and the risk there is that Sri Lankan banks have already been seeing weakening credit quality in the last couple of years. Non-performing loans have pretty much doubled in the last 24 months or so. So we really need to avoid converting this crisis into a banking crisis, which would result in a much more prolonged negative impacts for the entire economy. So in that sense, it's important that the government is able to find some way of sharing the credit risk. And I think there are opportunities here to look at lines of credit from external donors. That has been done in the past, which can really bridge this problem to some extent. There are other options to look at, not all of which can be made mandatory. If you look at small business in particular, one thing that the government could consider is to encourage landlords to offer concessionary rental charges for the next 3 months between April, May, and June, which can then be recovered later on in either 12 months or further down the line once things start improving. just because asset owners are likely to have more better wherewithal to be able to withstand the shock that we are seeing right now. Another option is for EPF, ETF contributions to be deferred for 3 months, and again to be recovered and caught up in 12 months, over a 12-month period once things start to normalize. The CEB could offer concessionary electricity charges for 3 months, given the fact that there's been a 50% decline in global oil prices, a 30% decline in global coal prices. The CEB should have significant savings this year, which it can to some extent pass on to small business as well. If you look at these 3 options, you're really addressing some of the biggest costs for business: your rental charges, your labor charges, and utilities. So having some kind of space on some of these areas would really help businesses to get through the most difficult time. Now, given the limitations that we are seeing on the government's fiscal space, whatever the government does in terms of spending really should be focused on supporting livelihoods of those most vulnerable communities, and looking at what we can do in terms of cash transfers in whatever way possible. Also, it's necessary, obviously, to boost resources towards the health sector in terms of capital expenditure, capital requirements like ventilators, and very importantly, to invest in enhancing our testing capacity as well, which is going to be critical to make this shift from a lockdown, from a curfew, to a more limited lockdown where people can start getting back to work gradually. So obviously, these measures are going to have a significant expansion in government spending. And as I said earlier, this does require parliamentary approval to raise the borrowing limit and to allocate public finances towards these services. So it's important that the government looks at either rescinding the Gazette of March 2nd, 2020, or implementing Article 70, subsection 7 of the Constitution that enables Parliament to be recalled in this case to pass these emergency allocations that are critically important in today's context. Yeah. So, in terms of dealing with the debt situation, given the fact that, as I said, we have 6 billion liabilities and 7.9 billion reserves this year, we will certainly have to try to seek some forbearance on at least our multilateral and bilateral liabilities maturing this year. And this is something that there is already some global movement towards as well. The IMF and the World Bank have also called for this. And this will at least create some space for us to settle the US dollars 1 billion ISB that matures in October 2020. And that will be important because the last thing we want to do is to default on our market-based borrowings. And in terms of providing the liquidity cushion, as I was saying, the reserve cushion, the reserve situation is going to be very tricky considering our debt repayments. So we will, I think, necessarily have to look at some support from the IMF. And there are options that we can consider that are not necessarily the same type of program that we had in the last 3 years. There are policy options like a rapid financing instrument, which can provide up to about $1 billion in reserve support, and it doesn't require a fully fledged program. You can also look at a standby arrangement, which I think is more suitable for our requirements. You can draw down a lot more, up to $3.4 billion for Sri Lanka. This can be front-loaded. There is some conditionality and quantitative targets, but I think this is also going to be important to restore some confidence in the global market. That's going to really help us in terms of coming back to some stability from the volatile situation that we're seeing right now. Finally, just a few basic thoughts on some sectors that I think that can really come out from this quite positively. Sectors like telecommunications, e-commerce, logistics, fintech. All of these, I think, what we like to see in the I don't know if it's too soon to say the post-COVID era, is that behavioral changes will occur quite a lot, and there will be a lot more uptake of some of these new areas going forward. So I think these are some sectors where we could see some positives and some momentum once we return to some normalcy on the immediate disruptions that we're seeing right now. Okay, let me end there. I'd be happy to take any questions that you have.
Thank you, Deshal. Thank you for the presentation. I think we have a few questions posted on the chat. And if there's further questions, please feel free, everybody who's on this meeting, to post them on the chat as well. If I just sift through the questions that's raised on the chat, we have one question that focuses on the fiscal support given to the business community that other countries are proposing to do. I think, Deshal, you touched upon that on your presentation as well. Do you want to add a comment to that?
So I've seen some of the fiscal measures that some countries have been implementing, and there are a lot of them are quite large volumes. I mean, more than 1%, 2% of GDP in many cases. Sri Lanka will find it difficult to immediately to put together that level of spending. But I think it's important that we have to have some increases, particularly in the areas that I mentioned on. I think with regard to the provision of liquidity and concessionary debt to concessionary lending for companies, it's important that the government does finance at least some of that. And that would be, I think, an important way of providing support in the short term through fiscal measures.
So in follow-up to that question itself, we have another question about the relief packages, especially fiscal relief packages on offer. And this question is on the interests that will add to the debt payments. And particularly for the SME sector, the question is whether there is an option where the government can look at a grant rather than a loan. Is this a proposal that you would recommend?
I mean, I think it'll be tough to from a fiscal space perspective for the government to provide grants, because you're looking at a large number of sectors, a large number of companies that will require this. So I don't think it's practical to provide a grant in this context. I think the best option is to provide concessionary working capital loans, as has been done, to provide as long a grace period as possible. So I think a year or above that if possible, and really stagger out the repayments so that you're not going to pressure your cash flows beyond that as well. But I think a grant is going to be very tough given the situation.
We have one question about the recovery that you can kind of grasp an indication on with the current scenario. What kind of recovery can we expect in Sri Lanka? U shape, a V, or L? Given the limited capacity of the government to provide stimulus, how are we expecting the recovery to really take shape as of now?
I mean, I think a V shape would be very optimistic.
Yeah.
Given the current context, I think it will be closer to a U shape, if anything. But yeah, this will have the overall impacts on the economy will certainly outlast the virus in Sri Lanka.
For everybody who's on this call and for your networks who couldn't connect on the call, we are definitely going to upload this on our social platforms, so it's recorded, the sessions. There's a few questions on that too. In terms of, Deshal, there's a question also on implications of using EPF to stimulate the economy. There were suggestions of this happening. If it's used, what would be the legal procedure? That's one question that came up.
Mm-hmm. Yeah, the legal procedure I'm not too sure about, but I think there are some practical difficulties with the EPF option, because basically most of the EPF funds are invested in treasury bills and treasury bonds, and basically you'd have to be looking at divesting a large proportion of, say, 20% of the holdings on government securities. That's going to have significant implications on government borrowing, on interest rates, on market interest rates. So that can be quite disruptive in this context. So I think it needs to be thought through, I think, a little bit more.
Yeah. We have one hypothetical question. How far do we think we are from being the next Venezuela? That's coming from Jeevan.
No, look, I mean, I think we have options of getting back on track, and I'm confident that the government will take those options rather than continuing on a downward path. I'm sure that because if we continue to print money and we don't do anything to address government revenue buoyancy, then there is a risk that we go down that path. But I mean, there's still enough in our control that we can avoid that. So yeah, unlikely right now.
Great. That's a positive comment to be looking at right now. One question coming right through. Can the government of Sri Lanka borrow from bank profits and offer tax concessions to reclaim the borrowing? Coming from Sabir.
From private bank profits.
Mm-hmm.
Well, I mean, so it's an interesting one. I mean, that's what taxation is for, right? You have companies make profits, you take taxes out of that and use that for your spending. Interesting question whether you can borrow directly off bank profits. I don't know. I mean, I can't really see how that would work, because
Yeah.
banks basically need to keep reinvesting their profits into their capital as well, to make sure that their capital adequacy levels remain, so that they can continue to lend and keep the economy going. If bank profits get eroded significantly, their ability to lend and to act as the engine of the economy then gets eroded. So that's a bit dicey.
Yeah. The next question, I think, is on international trade. So we have quite a lot of small business owners here who are joining, who are already experiencing restrictions and troubles on continuing international trade that they've been doing for the past few years. Do you think the government is looking at this in a positive light in future? Do we need further liberalization of trade as a country? Will that aid a fast economic recovery, and how can government help to do so? I mean, we can look at really use this as an opportunity to look at to lift off regulatory barriers and things like that. What's your comment and take on that?
So I think before we can even talk about liberalization, I think it's a question of when we can shift away from the significant constraints that we have seen on trade in the last couple of months. So the government has imposed a lot of measures on restricting imports, and again, that is being done really to protect reserves, given the payment dynamics that we're going to see in the next few months. So I don't think the government has the capacity to restrict imports for very long. Because imports are still required as intermediate inputs for a lot of domestic manufacturing and a lot of our exports. It's when tourism recovers again, you'll need to have imports across the board coming in to support that sector. And as I was saying, 50% of government revenue is collected at the border as well. So it's really difficult for the government to continue this level of restriction on imports beyond a few months. I think they will have to revert to a more normalized import structure at that point. I think the question of seeing further liberalization beyond that, I think it's a little bit unlikely at this stage, given the ideological stance of the government. The government generally has a stance more in favor of supporting domestic industries and promoting domestic production, and is less in favor of more kind of international orientation.
Right. Okay. The next question we have, Deshal, is on the infrastructure development that was taking place quite rapidly before this happened. Given the fiscal space contraction, the question says, what are your thoughts on the impact on the infrastructure development and their related spending plans in the future?
Yeah, so it will be difficult for the government to drive capex on infrastructure this year. So I think what will have to happen is they'll have to rely a lot more on private participation in infrastructure development. So PPP models have been spoken about, and we've started on those in previous instances as well. And I think it will be that kind of model that would have to really take precedence in this context, where the government has very limited space to drive financing of infrastructure on its own.
Great, thanks for your insights, Deshal. Anybody who would like to raise any further questions apart from what's been touched upon right now?
I think I saw a question on labor market flexibility
Yes.
and Seva. I don't think that that's going to be feasible. I think any moves uh, to the government, I think, will be reluctant to have anything that will allow companies to lay off people. I mean, from a political economy perspective, I don't think that's going to be tenable in this context.
I think Geeta brought up a question about the banking sector. You mentioned about unlikely collapse of the banking sector, and as this is an unprecedented event, those extreme scenarios are a lot more plausible as we have very little protection on deposits. What should we do to hedge some of these type of risks as even as individuals is the question.
So in terms of capitalization, banks are still okay. Sri Lanka's banks are capitalized above, to a great extent above the regulatory requirements. So given the capital situation, I don't think that there should be too much concern with regard to run of the banks and collapse in that sense. My concerns on the banking sector is more to do with credit quality. The fact that non-performing loans have really gone up in the last couple of years, and that's likely to increase further once the moratoriums are over. We are going to still see companies that are struggling to recover from the implications of COVID. And then before that, we've also had a lot of shocks in the Sri Lankan economy. I mean, since 2017, in every year we've had a massive shock. We had in 2017 the worst ever drought we've had in 40 years. 2018 we had a debilitating constitutional crisis. 2019 we had Easter attacks. So a lot of companies have been struggling to get through all of these shocks, and now we have this, probably the biggest of the lot. So you're going to see credit quality deteriorate even further in the coming months after moratoriums. So that to me is a concern in terms of for banks, because that then reduces their ability to churn capital and to act as intermediary effectively and to drive economic growth through that. But in terms of deposit safety and all, I don't think that that's something to be worried about right now.
And what role do you see of the development banks coming into this picture in Sri Lanka? We have a wide network of development banks already in place, but I think the context of their engagement overall needs to change.
Yeah, I mean, this is a story that has, come and gone several times in the last few decades. I think clearly there is a need for investment in long-term projects through venture capital model type of financing, and there is certainly space for that. And I mean, if we can have a development bank that functions well and does that properly, then that would be fantastic. But unfortunately, a lot of the development banks that we've tried in Sri Lanka have not really fulfilled that. I'm not talking about DFCC and NDB back in the day. I'm talking about more recent experiments with things like regional development banks and so on, which have not really been a good use of taxpayers' money in most cases. So really, it depends a lot on the governance structures and and how well managed and positioned those banks are. If it is done well, then yeah, I think there's space for it.
Great, thanks, Deshal. I think there's one question that we can take. One actually question on horizontal mergers. Is this a good time, you think, for companies and enterprises to consider a very innovative way of doing business through horizontal mergers? What's your take on that?
Look, I think there are it's a great time in terms of valuations and in terms of being able to when there's disruptions, you can always find good companies that need to have capital infusions to survive and so on. So from that perspective, yes, it does make sense. But at the same time, I would caution that given this kind of volatile situation and uncertainty with regard to outlook, it probably makes sense to just wait a bit to see how things pan out and develop in the coming months before making quick moves towards that kind of decision.
Great, thank you. I think we've used up an hour. And thank you, Deshal, for taking time to prepare this presentation. I think also tweaking to the most updated information that you have to share with us, and for really answering through all the questions that the audience had to raise. Thanks so much.
Thank you. It was a pleasure.
Thank you, everybody, for joining.